This video is going to focus on Unit 2, Topic 6, which is all about financial planning and making informed choices. As part of the video, we're going to be looking at some key terms related to both demand and risk. Then we're going to be looking at matching a product mix to people's circumstances and the impact of external factors. So, some key terms related to demand. The first one is derived demand. What does it mean? It's where financial products are not wants in themselves. People actually use these financial products to achieve their wants or aspirations. So, for example, a mortgage enables purchase of a property that would otherwise be unaffordable. So that you wouldn't get a mortgage for the sake of it, it enables us to achieve other wants and aspirations. Joint demand. What is joint demand? When two products are bought together because they are complementary, it is known as joint demand. So when it comes to financial services, a mortgage buys a home. A loan buys furniture to put in the home. So you're taking out a mortgage and buying a home at the same time. They are complementary. They enable each other. So, competitive demand, what is it? Well, competitive demand is a situation where two or more products fulfill the same need or want. They are therefore in competition with each other. So if an individual wants to put some money into a savings or investment account, well, both savings products and investment products are vying for that person's money. Essentially, they are competing for that person's money. Likewise, two savings products are also in competition. They both want to attract that individual to put that money into their savings product. So the risk and reward spectrum, we've covered this in a previous knowledge blast, but just to recap, our attitude to risk is affected by a number of different points. It could be affected by our personality. Are we a risk taker or are we more risk averse? It may also be affected by how much money we have. If we have a significant amount of money, we may be actually more willing to take more risks compared to if we are just getting by, we may not wish to take a significant amount of risk with our money. It might also be affected by how old we are and thus the stage we are at in the life cycle. If we are approaching retirement and therefore are planning our retirement, we may not wish to take too significant a risk with our money at that stage of our life cycle. Whereas if we are at the young adult stage of the life cycle, we can afford to take more risks because we know that we have a significant amount of time in order to make up should we lose money on adverse investments, for example. It may also be affected by other people who could be affected by our decisions, our dependents, for example. If we have children, it's highly likely that that will affect our willingness to take risks because, of course, it wouldn't only be ourselves which would be affected by it, but also our dependents, should we lose money. So, some key terms when it comes to risk. The following key terms, what do they mean? Capacity for risk, risk tolerance, and self-insurance. The first one we're going to look at is capacity for risk. This is the amount of risk an individual requires in order to meet their goals. This can be described as the total risk. So someone's risk level is the amount of risk that individual requires to meet their goals, so their capacity for risk. The second one is their risk tolerance, the amount of risk that an individual is comfortable taking, or the degree of uncertainty that an individual is able to handle. Risk tolerance often varies, of course, as we just mentioned, with age and income. So capacity for risk and risk tolerance will and are likely to be different. And finally, self-insurance involves setting aside your own money to pay for a possible loss instead of purchasing insurance and expecting an insurance company to reimburse you. So self-insurance, essentially, rather than purchasing insurance, you are setting money aside in order to pay for possible losses you may experience. So, how do we match a product mix to individual circumstances then? Well, when considering product mixes, individuals should consider their attitude to risk. How much risk are they willing to take on board, and what level of risk are they comfortable with? They should also consider the time scale they have. If they have to or are eager to get a very high return in a very short amount of time, they may be having to accept a higher level of risk. The return they require as well. If it is a particularly high return, once again, they're going to have to take a more risky product mix in order to get that return that they require. They will also have to consider whether any remedial action is required. If they have specific wants and aspirations in the future, and they are not yet on track in order to be able to afford those wants and aspirations, they may have to put remedial action into place, potentially by reducing their outgoings or indeed increasing their income, potentially through taking on a second job, for example. It's always wise when matching a product mix to one's circumstances to seek advice and guidance. I've covered this in a separate knowledge blast and I'll leave the link in the description. So, how will these external factors affect financial planning? Interest rates, firstly. When we are planning financially for the future, interest rates can have a huge impact upon our financial plans. If interest rates, set by, of course, the Bank of England and Monetary Policy Committee, if they increase, then that could be beneficial for people who are saving. This, on the flip side, may be negative for people who have borrowed. This, of course, would mean that they would have to pay back more on any money that they've borrowed, a loan or a mortgage, for example, which would take disposable income out of their pocket and therefore affect any financial plans they had for the future. They will have to take that external factor into account. A second external factor which could affect financial planning is the rate of inflation. Currently, the inflation rate is particularly high, and therefore this will mean that people's cost of living is likely to be higher. Therefore, they may have less money left over in order to save or invest, which would of course affect their financial planning and potential plans for the future. And thirdly, house prices. If an individual is saving or investing in the hope of putting together a deposit in order to purchase a house in the future, that individual will have to consider the changes in house prices. House prices generally increase or appreciate over time, and therefore that external factor will have to be considered. The individual will have to increase the amount of deposit they have over time, whereas £20,000 might have been okay for £80,000 house 15 years ago. If that house is now worth £160,000, double the amount of deposit is likely to be needed by a lender. So, let's test our understanding of topic 6 with some multiple choice questions. The first one. Gethin and Nia are both in their 20s and would like to start planning for their retirement. At what age should they start putting money aside towards their retirement planning? 30, 40, 50, or as soon as possible? The answer to question 1 is D. The earlier you start putting money aside for any event, the more time you have for unforeseen circumstances. Question number 2. Which of the following is most likely to result in the need for someone aged 35 to amend their 3-year financial plan? Is it changes in A. Annuity rates, B. Demographics, C. Interest rates, or D. The state pension rate? The answer to question 2 is C. Someone aged 35 is likely to have a mortgage, so a change in interest rates may affect their outgoings. And question number 3. Budgeting is often easier for employed people because A. Their income may be irregular, B. Their outgoings are always high, C. They cannot predict their outgoings, or D. they have a fixed income level? The answer to question number 3 is D. Employed people tend to have a fixed level of income.